Hey everybody, Russell Gray, co-host of the Real Estate Guys radio show, here with another edition of Boots on the Ground for September 2020. And in this episode, we're going to be talking about commercial alternative funding choices. And of course, debt is a big part of what we use as a tool, power tool in real estate. And so having a great loan guy or a team of loan people on your advisory board is really, really important. And so we're going to check in with our good friend, Billy Brown. Hey, Billy.
Hey, Russ. How you guys doing today?
Good. Excited to be talking with you.
Yeah.
You know, I feel like we could update lending maybe once a week. You know, we do this once a month or so, but, you know, rates change, mood changes, underwriting guideline changes. So before we kind of get into the weeds, just top level, big picture. What's the mood of the market out there? Are lenders feeling a little bit happier, or are they starting to tighten up?
Well, you see by the smile on my face that things are going better than expected. You know, it's a grain of salt there for the lenders. They're actually getting a lot of good news out there in the economic world. They're feeling very bullish on a couple things, including single family rentals and new construction. Obviously, multifamily has always been a mainstay. But in the, obviously hotels and offices are still, they don't really want to touch those right now. Light industrial, if you need light industrial right now, you can get pricey any kind of lending you want. But for most of the people who are going to talk about here, they're going to be in the single family rental, multifamily rental. And these guys are really, really bullish on this. And they've got money to deploy and it's getting cheaper. Now, I don't know how much cheaper it's going to get before the election, but for what we're in right now, it's pretty dang good. I think last time we talked on the portfolio lending where you take, somebody, we explained this last time, you get somebody's had a bunch of 1 to 4 family, single family rentals. They may have used a Fannie Freddie mortgage on those things, personally guaranteed them, but they're getting a little pushback from the mortgage lender. We're actually taking those those into one loan, one mortgage payment, basically one payment that pays the taxes and insurance, and it's non-recourse. And those rates were starting to get high, and now they're coming down, and they're coming really down. If you got a bunch of these things, even with the bank lenders and all that, I mean, if it's a portfolio above $2 million, you're almost in the high 4s on your interest rates, low 5s.
Wow. Okay. And these are refinances, right? I mean, obviously you're refinancing.
Too, yeah.
Are you able to get some cash out on that deal?
Oh yeah. Yeah. There's no restrictions on the cash out. I mean, as long as the debt services, they'll write your check. And the money that you get is no strings attached either, where a normal bank lender is going to have some strings attached. Yeah.
Okay. Well, so to be clear for everybody, if you're not familiar with this concept, the idea is that if you've gone out and you've used your personal credit and you've purchased properties in your personal name, and then you've taken advantage of, agency or Fannie Freddie GSE, government sponsored enterprise money, or maybe even VA, whatever it is, you've gone out there and you've bought these homes and you've rented them out and you've owned them for a period of time and you've got positive cash flow and you've built up some equity. But you've reached either the point where you're Fannie and Freddie'd out and you can't do any more of that, even though those loans are great, or you just got a bunch of equity in them and it's going to be kind of time consuming and expensive to go refinance them one property at a time.
Yep.
Billy has people that will actually lend on the entire portfolio and then allow you to extract equity. So one loan over everything frees up all those Fannie Freddies so you can go out and add more. But the other thing that is kind of a neat deal is you can do these things to entities too, right, Billy? In other words, because one of the big downfalls for a lot of people in investing is they discover, gosh, all of a sudden I own all these properties. I got all this liability exposure, and yet I have a really hard time putting my properties in a limited liability company to shelter me from some of that because of the lending. But this solves that problem. So that's another little bonus, right? Do you see people doing that too?
Yeah, we're having a lot of calls up for people that don't get either their bank or obviously Fannie Freddie won't lend to an LLC. So you get that's a beautiful thing about the non-recourse part of it is part of an LLC and it's non-recourse, its own little bubble. It's also its own little asset as well because that whole thing can be sold.
Yeah. And to be clear for everybody, because we're throwing buzzwords around, but non-recourse just means that they can't come after you. There's no personal guarantee. In other words, the only recourse they have is the property. So if things go sideways for whatever reason, you decide you want out, you just give them the keys and the deed and you're done. And that was the deal. They're either going to get the payment or they're going to get the property.
Pretty straightforward. Now, most people are going to say, hey, well, I'm not going to give it back. And because they're good borrowers or good people, like most people on the show. But, I always look at it from the lender's point of view going, well, if you're not personally guaranteeing these things and it has its own little asset, you actually look much better and much cleaner to a lender. And it's a lot easier to get your loans done once all those personal guarantees are off your personal balance sheet. Your banks and even the Fannie Freddie guys will work with you much easier. And that's the speed at which money is needed for these things is an advantage.
Yeah, I think a lot of people think that when they are doing single family homes, they are just always going to live in the single family loan world, and that commercial loans are really for people who are doing bigger properties or commercial type properties. But since we started working with you, we realized that's not true, right?
Yeah.
You can take advantage of the benefits of commercial lending. And yet still stay very much in the single family space. So that's pretty cool. Let's get back onto what's going on. So we know interest rates have come down a little bit.
Yep.
What about underwriting guidelines? Loan to value, cash reserves. What are they looking for in your balance sheet? Is it getting easier? Is it getting worse? How's that looking?
So I'll give you the straight up answer, which is it's getting a little bit better. But also say like the leverage points are a little bit higher, between 70 and 75%. Their underwriting is what I would suggest is good. It's good for investors because these things have to cash flow after expenses and after potential vacancy. If it's 100% occupied right now, you've got to factor in eventually this thing's going to vacant. And that's actually a good underwriting for you as well as lenders so you don't get overextended. So I think, from the underwriting, most people say, oh, that's too tight. And then the reserve requirements, some of these lenders will escrow, 3 to 6 months. Some will do, 12 months, depending on the size of these things, because they want to be sure that they're, talking millions of dollars. They want some security there. But you still have access to that if things go south. It's still your money. It's just set aside for the oopsies.
Yeah.
And then again, the lenders are partnering these things. So there's some wiggle room in there, but I'd say overall the guidelines are actually normal and as they should be for an investor. If you look at it as a business, not just, hey, I'm going to sign the personal guarantees and all these loans, you want all these things will cash flow after all the expenses.
Yeah. Well, I mean, obviously, as we sit here in September of 2020, the big concern is the economy, jobs, eviction moratoriums. These are all things that would give lenders fits. At the same time, on the other side, you've got a lot of monetary stimulus, the Fed coming out saying, hey, we're going to keep rates down for the foreseeable future, which means we're going to be pumping money into the system to continue to buy bonds. And that money, goes around and it looks for a safe place, especially on the debt side. People that end up with the money and they want to lend the money. Because the thing that people don't understand, I think a lot of people don't understand is, money in the bank to you is an asset, but to the bank, it's a liability.
Yes.
And so they need to find an offsetting asset, which is they need to make a loan. And so a lot of times you can learn about where an economy is headed, not always, but sometimes by the mood of the lenders, right? And so within the space of real estate, which is lots of different niches, you opened up talking about how there's certain niches they're a little skittish of, and then other ones that they're feeling a little bit more bullish on. And it sounds like residential is still, and industrial, I mean, some of what I'd call the consumer staples, right? The things that people have to have, still appealing to the lenders.
Yeah, that's the great thing about what I do. I mean, I usually, before our call, I usually, survey my lenders and kind of see what their appetite is. A lot of them I talk to them literally every day or every other day to see updates on loans and all that. So I was just checking like, what's new? What's the pipeline? Tell me about capital markets. I got friends in New York City. We're just like, top level stuff going, what's going on there. So we have a pretty good pulse of what's going on and when they're happy and when they're not so happy. When they're happy, they'll actually pick up the phone. When they're not happy, they're not picking up the phone. In fact, for many months during the COVID shutdown, they just wouldn't answer emails or phone calls or text messages or nothing. Or it was like they're silent because there's nothing you can go do. There's no money out there. But that's a great way, like you said, to test the economy and what's going on in micros or macros. Just go talk to lenders. Going, what are you guys bullish on? What do you guys like? What do you don't like? What's going on internally? Because if they're a little fretting and they're strapping up their resume, they know there's been some big changes. But if they're rolling out new loan products and excited, and they're calling you about some stuff, you know that they're, you know, they got money to lend, and you might as well, you know, they're seeing something in the marketplace. You need to go figure out and how to borrow that money.
Okay, so with your thumb on the pulse, like on a scale of 1 to 10, 10 being, uber bullish, it's like sunshine and unicorns, and, 1 is, oh my God, it's Armageddon
Yeah.
and the end of the world as we know it. Where would you say that you think your lenders are right now?
Right now, this moment before the election, I'd say they're probably about 8 or 9 on certain assets, including like single family and multifamily. They're starving for deals to go lend on. The portfolio lending is sort of big things because they've got think about this. They've got people in, the capital markets looking for large tranches of loans to go buy, 250, 300 million. So they got to go produce those. So they got to go create products to go attract those type of loans. So they're going and doing it.
Yeah.
The portfolio lending now to sweeten the deal, anything above $2 million as far as the portfolio size is getting some really great pricing. Conversely to that, I don't say conversely, but another alternative is people like looking at these lines of credit where they're shut off. The bridge lending in the multifamily world and the lines of credit for those multifamily are back, and they're getting very aggressive. And the pricing is actually coming down.
Okay.
Leverage points are coming up, so you can go sweep up some stuff that that's not stable that a normal bank or normal the agency debts won't lend on. But also the single family new construction stuff. I've been harping on this for people that may not want to go syndicate a multifamily or something bigger that are in their sweet spot with their zone for their single families. You can actually partner with people that have liquidity. If you have the experience, and I have a lender right now that will 7x the liquidity in your bank account. You can actually do a full-on syndication, almost a blind fund with this thing. So you got to go raise $1 million. You get $7 million to go play with there as far as line of credit, and they'll do 85 to 90% of the cost plus rehab on these properties. Same thing on new construction. So whereas most bank lenders are going to be 65 to 70 and take, as far as leverage points, take 2 to 3 months to get to you, this is basically a pre-approval. They'll go 90% of the cost and close in 2 to 3 weeks.
Wow.
So they're very, very bullish on what's going on. And again, non-recourse. So if you got listeners out there that have that kind of experience, that kind of portfolio, looking to speed up, they want to stay in their lanes of the 1 to 4 single family stuff and new construction, they're kind of sick of their bank lender taking so freaking long. This is a great alternative.
Yeah. Well, Billy, you mentioned syndication, and again,
Yeah.
no investor left behind, because we
Yeah.
never know when we stick this out there, where people are at in terms of their understanding. But I know a lot of people look at real estate and they think it's super complicated, and it's really not that complicated. You have debt, you have equity, you have income coming in from rents, and then you have to put all that together so that it pencils. And of course, if a lender's involved, the lender is going to make sure that it pencils. You literally learn by doing the deal, and the lenders coach you up. I've been through that. And then the other part of it is understanding that whatever you need to present to the lender, if you don't have it, you can go get it. So I don't have a down payment. You can get partners. I don't have good credit. You can find people with good credit. I don't have experience. Find people with experience. I don't have a good balance sheet. Find people with a balance sheet.
Mm-hmm.
If you're really resourceful and educated, then what you can do is you can put all of those pieces together and get a piece of the action for being the organizer, the sponsor, or the syndicator. That's what we teach at our Secrets of Successful Syndication training. And that's why we do it, because a lot of people make real estate so much harder than it needs to be. It's actually easier to go bigger. And because you can hire help and you can bring on partners, and when there's a lot more meat on the bone, not just percentage wise, but just absolute dollar wise. I mean, if you're doing a 10% deal, let's say, and it's $100,000 property, you're going to make 10 grand. Right. You're not going to get very many people to the party for that. But if you're doing a $10 million deal and there's 10% on the bone, right now, that's $1 million. You're going to be able to get more people to the party. If you're doing $100 million deal and it's a 10%er, right now, you've got $10 million on the bone. So I think when people kind of understand that, and that the other part of it is the environment we're in right now, is all this money, all this stimulus money gets into the economy through lending.
Mhm.
And so you can see the stimulus is beginning to make its way into the marketplace because lenders are eager to lend. That means there's people in Wall Street that are eager to buy because that's where
Mhm.
the funding comes from. Investors, probably proxies for the Fed, show
Yeah.
up in the marketplace and say, hey, we want to buy anything you have, and we are willing to pay a lot for it, which means, low interest rates.
Yeah.
And so people are like, great, well, let's go figure out how to create that and make some money, right? And so these guys go out there and they say, hey, we'll do it for this. And somebody else says, well, we'll do it for even lower. We'll do it for even lower. And it gets very competitive. And I guess what I'm hearing you say, Billy, is that's what you're starting to see. I don't want to put words in your mouth, but you tell me, is that?
Right now, there's a lot of competition in the marketplace to go find yield and on the debt side, and that's good for investors as far as products. Now, how long that stays around, I've been listening to you guys for too long, and everyone else. Like it's election year, anything can happen. It's 2020, anything can happen. But right now, they're very, very bullish on this, and I always go with what the lenders want to go lend on. And go, well, if they want to go lend on this, they see something in the marketplace that we need to know because they've got a lot of money and a lot of sources and resources that we don't have. So let's go jump on it and see what we can make a buck. But we know there's a shortage in single family rentals. There's a shortage in quality housing. There's a shortage of affordable housing, and they're doubling down on this and to a very good degree. Where they're trying to attract the best as far as sponsors to be able to throw this money at it and get away from the depository institutions.
Well, good. Well, I mean, that's exciting, Billy. So we need to wrap up here. We could go on and on. I get so excited when I get a chance to talk with you about all this stuff. But we do this regularly. And of course, if anything happens big in between, our regularly scheduled updates, just let me know and we'll do a special edition. But it basically sounds pretty bullish. Rates are down. Underwriting guidelines are stable. There's certain niches that people are interested in. You can do cash out. And of course, there's all kinds of things you can do with the cash. So it all sounds actually pretty good to me, which is nice because, you read the mainstream headlines all the time. It's like, oh my God, the world's coming to an end and this is bad and that's bad. But at the street level, when I do these interviews and I talk to you folks, I mean, it just sounds like there's a lot of great stuff happening at the street level, lots of opportunities. So people who are sitting on the sideline, taking a wait and see approach, I think it's a huge mistake. I think, I'm a big fan of think and do being better than wait and see. And this is a time to get educated. So if you're watched this far, congratulations, right? You're one of those people. And good for you. And Billy, we have your contact information and I think past episodes, podcasts, maybe through reports down in the show notes. So if you're watching this on YouTube, just go down into the show notes and you can find out all about that. But any closing thoughts before we wrap this thing up? Anything you think people need to know about the State of the Union in commercial alternative lending in September 2020?
Yeah, so I think jump on the money now if you got it. Just because you get the line of credit doesn't mean you have to use it. You're just prepared. You got dry powder ready to go. So go start it. The approval process takes 5 days. It is not hard. Second thing is educate yourself. Obviously, you're going to put out some more information on secrets of syndication. That's how we got our teeth cut. We got 2 syndications that we did in 2019. And trust me, it's amazing. It's all because of you guys. So thank you very much. Anyone that's watching this needs to jump on this thing in the September location. But I think don't wait around. Jump on it. There's plenty of opportunities out there if you know how the numbers work. And there's plenty of people out there just scared to death of Wall Street. Go rescue their money. Go partner with some great investors that know how to go buy real estate and make their money secure.
Yeah.
And then it's going to be a great year.
Well, it's easy to create equity when you have cheap money to work with. And so that's great. And if you already have equity, it's a great time to grab it because just in case the market does turn sideways, it's better to be liquid. When you're liquid, then you have the opportunity to create equity by buying great if there's bargains. But there's a lot of opportunity in the marketplace. I think that's the bottom line. So excited to hear that you're seeing that also. So keep us posted and we'll look forward to doing this again. Okay, Billy?
Sounds good. Thanks, Russ.
Thank you.